So thank you for attending this webinar, and I hope that by the end of this little webinar, educational webinar, you have a much better understanding about the balance sheet and the importance of it. Let's consider as a start the thought of the day. The secret of change is to focus all of your energy, not fighting the old, but building the new. That's pretty deep. We can't change the past, but we can influence the present and the future. And today's session is about building a better balance sheet in the future. Now, balance sheet can seem quite technical, and part of this 40-minute or so webinar is going to involve numbers. And if you get a little bit lost, just write down what made you feel lost, and we'll cover that at the end of the webinar. Or I can slow down if you ever have a comment and you want me to slow down and go through something again. Make a comment or a share, and Rhonda, the moderator, will be checking those. Before we get stuck in, I do want to throw in our usual disclaimer that information in this webinar is educational in nature, and it's no substitute for sitting down with your accountant for tailored advice specific to your particular circumstances. I hope that by the end of the webinar, you'll be really captivated by your balance sheet, just like I am, and how to improve it. So this is the agenda on what I'm trying to cover in the next 40 minutes. We're going to talk about the balance sheet, the story that it tells us about where your business is right now, and discuss practical strategies for making it better. We're going to cover 4 important areas of focus, all of which, when you work on them, will maximize the business value for selling purposes at the end of the time when you stop wanting to run your business, or just make it an easier business to run because your business is running better. We'll come to some best practice tips, and we're going to focus, as I said, with a question and answer service at the end. So get ready to send in your questions at any time, and then we'll answer them. So let's get into the nuts and bolts of this balance sheet. So often we see business owners and their consultants focusing energy on the profit and loss statement. This is to look for ways that drive up revenue and drive down costs. And this is important. However, understanding your balance sheet will help you, because profitable businesses do go broke. Happens all the time. If you did certain activities which drove up your sales, but then you didn't have a great system for invoicing your clients, so there was a delay in the invoicing part, or there was a delay in collecting the money once you invoiced, then your business may run out of cash. So you've driven up sales, but a sale isn't really made until the money's in the bank account. And so a growing business may also overinvest in stock, and then in a downturn find themselves overstocked. Now, this happens frequently during these COVID lockdowns, and particularly to the hospitality businesses, because they can be buying in stock for a whole weekend of trading or a week of selling food, and then suddenly there's no customers coming through the door. They still have to pay their suppliers, and so there's no cash to pay the suppliers, and the business can go broke even though it was extremely profitable. So cash is described as the oxygen in a business. There are many ways to increase cash flow. I'm going to just cover some of the areas to look at in this webinar, but it's not really about the cash flow, so it's only a short mention. But the balance sheet is where your cash is measured, and there are some useful ratios and calculations that you can do to show how much cash you can create by changing various processes in your business. So a banker and your accountant will look at your balance sheet every year to see if your business is solvent. So should you. So trading while insolvent is extremely stressful, because you'll find it difficult to pay the bills, and it puts you personally at risk with creditors, the IRD, and the bankers. So there's a test to show at a glance whether your business is solvent or not, and I'll talk about that in the next half an hour. So in a downturn in particular, it's really careful to watch your own personal spending, because tax bills lag behind revenue. And so you may think you've got $10,000 in your bank account and you withdraw 5, but suddenly a tax bill comes and that 5 was required to pay that tax. So having regular checkups with your accountant means this is less likely to happen, because you can understand when the tax is due and how much it's going to be, because you're more in touch with your own numbers. So having a war chest of cash, of savings, an emergency supply of cash is always helpful, but especially helpful to a business that's growing. And it's essential when there's this environment we're living in where lockdown's going to happen, because if profits are down or you're making a loss, then with a strong balance sheet, you'll weather the storms, you'll just ride it out. You can hibernate for a little bit. But if you are in a really dicey position and a storm comes along, well, it's just like being in a leaky boat. It doesn't mean the business can't last. So moving on, what does the balance sheet tell us? Well, it's a story, and it's known in accounting terms as statement of financial position. That's what we call it. And it's a snapshot. It's like a camera snap of what the business was worth as at 31st of March, which is today, which is why I'm running the seminar, because the 31st of March is the day that we ask clients to do a stock take, to check their debtors, to check their creditors, because at the end of the year, we're going to be asking for those figures to find out the true snapshot of what the business was worth as at 31st of March. It measures the net worth of your business. Net worth is assets less your liabilities. This is the asset test that shows if your business is solvent. If your liabilities are greater than your assets, then your business is insolvent. And insolvent businesses can continue and can later make a profit, but urgent action is needed to fix this. You can't keep running an insolvent business or you will fail. You can use a balance sheet to compare different periods between 31st of March this year compared with 31st of March last year. And this will tell you whether your business's net worth is increased or decreased. And that will help show the strength of a business. The stronger your balance sheet, the easier it will be for a business to survive a downturn. And also, a balance sheet helps us with calculating key ratios such as the debtor days and working capital and current ratios and things that I'll go through a little bit later. I'm going to start with an example. So this is where we get into the numbers. So stay with me, and I'll try and take it a little bit slow, but not too slow to bore you as well. So we're starting with a building company as our imaginary company. And the first part of the balance sheet is the equity or the owner's interest in the business. Actually, in zero, it's often at the very bottom, but there is always an equity section. The yellow markings will show you that last year the business made a profit of $71,000, but this year it's making a loss of $45,857. This has eroded the strength of the balance sheet, and so it went from having a net equity asset position of almost 48,000 down to just over $2,000. This means if the company makes another loss of more than $2,000, it's going to be technically insolvent. So strategies to improve the profitability of this business are needed very, very urgently. So we're going to build the balance sheet bit by bit, and I'll go and explain it as we go along. The company has a bank current account, sometimes known as a savings account. This savings account has $11 in it, so not very much towards tax. I do recommend that you have a tax savings account, and that should have money in it most of the time so that you can pay your tax as it falls due. There is an income tax receivable amount here of $5,000. That means that tax was paid through the year when actually there was a loss, and so that tax shouldn't have been paid. So we can probably we'll claim that back from the IRD, but if they had had more regular tax updates, they may not have put their pressure on cash flow by paying that tax. That tax became receivable because of the profit last year, but because of the loss, it's now no longer payable. The opposite can happen, of course, and you can end up having a surprise tax liability if you've made money but not paid tax. So the next part of this balance sheet is inventories, and we've got stock on hand, which has got a large increase. So that's meant that money's gone out of the bank account and into increasing stock, which is awesome if it's going to be sold quickly. But if it actually sits and it's just not being sold quicker, then you're actually reducing your cash by a significant amount. The good news in this business is that work in progress has been reduced significantly. So less cash is tied up in uninvoiced jobs from work in progress. The shareholder advance account is shown as an asset of $66,494. What does that mean, Michelle? What it means is that the shareholder has taken out this money from the company. This isn't good, because if the company fails, a liquidator or receiver can demand the money from the shareholder, and they won't have the protection of the limited liability of the company and will be personally liable for it. It's ideal to always have the shareholder advance account in credit. And if it's in debit, you will be required to pay fringe benefit interest, fringe benefit tax on the debit balance at the end of the year, and that's shown in the profit and loss account. We do that calculation frequently. It's not a good one to do, but we do have to do it legally. So the shareholders are taking out more of the cash of the business than what they're entitled to. And that's what's caused the balance to go up. The other thing in this slide talks about accounts receivable or debtors. You can see the balance owed has gone down. So this has freed up some cash because cash has been collected a little bit, and it's now taking about 48 days to collect the debtors. And we did that debtor days through understanding what the sales were, but I'll go into that calculation a little bit later. There is very little value tied up in this business in non-current assets. You can see the property, plant and equipment's gone down from 38,000 to 15. So a big question mark for bankers and funders is dropping value of assets could indicate fixed assets are due for replacement. So this is a signal of eroding value. It could be a further drain on resources when those assets are replaced. And so a banker looks for things like this. The reduction in total assets this year is only 15,000. You can see 297 to 282. But that's because one of the assets that's increased is the debt to the shareholders. So the true asset reduction is a lot more than that. It's more like 48,000. You can have a look here and you can see the Visa balance has increased. The bank account overdraft has slightly increased, and so this is showing that there's going to be, and this account, this profit, this is showing that the bank is starting to perhaps get near its limit. I don't know what the limit is in this example, but what we would look for as an accountant in here is some of this core debt. In other words, is it going back up to zero every month, or is it staying fixed at this price, at this 38,000? And if it's core debt and it's not fluctuating much, perhaps we can take 20 or 30,000 out of the overdraft by putting it into a term loan and paying off the term loan over 5 years and taking less interest and have less strain on the business. However, I wouldn't be suggesting that if the business is going down the tubes. And so it would be important to make sure that there was the business was profitable and that this was a short-term problem, not a long-term viability problem. Lastly, there's GST. It's a lumpy expenditure because it's not payable every month. It's a good strategy to preserve cash flows. Just put a set aside an amount every month for GST. I do this. So, and I have for many, many years, I just have an automatic payment paying off a lump sum into my tax account. And that means that when we calculate the GST that I have to do, there's always money there. And sometimes I feel like I can't afford that lump amount, but I still do it because to me, paying my tax is extremely important and I don't want to strain to do it. So if you talk to us, we'll work out how much you should be setting aside each month or I do it fortnightly, each week, each fortnight to put aside for tax to make sure that you always have the funds available and it's not a stress on your business because it's spread out over the whole year. Now you can note here that income tax was payable was $15,000 last time, and that was because, of course, the profit was $45,000. This year there's a refund owing, but having regular updates of your tax position, large fluctuations in tax payable can be avoided. Just a quick note that there's a phone loan, yeah, that's right, here, which seems to me probably an expensive way to pay for a phone. And so you have to watch the asset finance interest rates because sometimes they are a lot higher than what the bank overdraft is or a home mortgage or something like that. But the biggest strain on this business and why I think if I was the owner of this business, it would be hard for me to sleep is this massive increase in trade and other payables. In this example, the trades, the suppliers of this business are not being paid for 74 days, and last year it was 47 days. So not having sufficient cash to pay suppliers means that the owner of the business is constantly going to be asked for by email and phone requests for payment, and not being able to satisfy that because you just haven't got the money in the bank is extremely stressful way of running a business, and you would feel very it'd be very disheartening to be in that position. So this is definitely a balance sheet that needs boosting and it needs some strategies to improve it. So the last part of the balance sheet is the balance sheet business loan has been refinanced, and often refinancing is a really good thing to do. You can save thousands of dollars by getting interest from another bank. Do remember that you have to have legal fees, sometimes valuation fees involved in changing a mortgage, and so you have to think carefully if it's going to be worth it or not. So with net assets of only $2,000, as I said before, this company has no ability to borrow further funds, and it will fail the second test of solvency, which is always to have the assets greater than liabilities. And I'm going to show you why it fails in more detail later. So with a reduction in net assets of over 45,000 from that to that, we need to be thinking how we can boost the balance sheet and reduce risk. And what would you do first? That's a question. Before I answer that question, I'm going to talk about your balance sheet. So presumably by now you have downloaded your own balance sheet and looked at your own picture and your own story. Has your net worth gone up or down compared with last year? And in particular, what numbers have increased and what has decreased? And do you know why that has happened? And if you don't, write that down, because that's a conversation that I would love to have with you and get into that and help you understand your own numbers. It's my favorite thing. Whatever the story is showing, we can't change, as I said before, we can't change the past, but by making changes to our business processes, we can improve the present and the future. So let's concentrate on things you can control, and I'm going to give you strategies to turn around this building company, and potentially one of these strategies might help you as well. So there's 4 areas that we're going to focus in on for the remainder of the next 20 minutes of this webinar. Profitability, cash flow, solvency, and the shareholders' advance accounts, all important areas. The first focus is 7 ways to grow a business on building profitability. To grow your business will build your profit. Well, as long as you are trading efficiently. There are 7 ways to grow a business, and we cannot focus on all 7 ways at once. And so what you have to do as a leader of your business is to choose the area that you think is going to make the most difference quickly and focus on that. And when you feel that you've successfully focused on that enough, then you can choose another area. So which area would you like to focus on to grow your business? Firstly, do you want to increase your own customer retention? So delight your clients more, under promise, over deliver, so that they refer more clients to you and don't defect to your competition. Do you want to generate more leads? So that means you have to focus in on your marketing and look for how to bring more customers into your business via referrals, testimonials. Do you need to use social media? Cost-effective strategies to generate more leads. We've got many suggestions for people to help them generate more leads, and so that might be an area that you want to get into. To convert more prospects into customers, we focus on sales training, and I have just in Tax and Trust run a 6-part seminar on selling your value to clients, and so increasing the value to clients, and that looked at strategies and increasing your proposal acceptance rate with prospects. So sales training for that one. Increasing transaction value. This is implementing strategies to encourage customers to spend more with you when they come and visit you. And so you can't just put the price up, although that's one strategy. Usually you have to increase the value that they are given, and because of that, they will pay you more. Adding fries with that is a perfect example of upselling with McDonald's that we all know about. Increasing transaction frequency is looking for ways to encourage your customers to buy from you more often. Can you offer a reminder service? Can you stay in contact them with emails and suggest other services that they may need? So that's another strategy. Reducing variable costs, and this is really focusing on eliminating wastage and rework and things like that. Consider negotiating better pricing with your suppliers. And finally, reducing overheads or fixed costs, and these should be reviewed at least annually to make sure you're getting the best deal that you can. Example, if your team are working more from home, can you downsize your office space? Can you get a better deal on utilities or your phones? But be careful when you're reducing overheads that you're cutting fat, not muscle. So some overheads can be seen as investments. For example, you need to purchase a new vehicle because you don't want to pay the repairs bills, or investing more in your accountant because you want to help to grow your business. Seriously though, if you see us as a cost, then we should be cut like all costs. But if you see us as a partner in helping you run a better business, then we'd like to work with you more. So I've got literally hundreds of strategies to help you with in each one of these areas. And we will be running a seminar in-house later this year to focus more on growing your business, 7 ways to grow your business. If you'd like to sign up for that seminar, please signal this into the chat box and we'll put you on the invite list. And as soon as we have about 8 people, then we'll run the seminar. The second area of focus to boost your balance sheet after building profitability is to improve cash flow. The cash conversion cycle shows us how long it takes from receiving a payment from your customer after buying the stock from your supplier. In other words, how long is your cash tied up in inventory and accounts receivable? Now, clients without stock, instead of buying stock, they may start this cycle on when they start working on a client and pay for either supplies for a job or labor towards a job. We buy stock from our supplier in day 0. We pay for their stock 35 days later. In this example, we sell stock to the customer in 65 days. That means our average stock holding is 65 days. We receive the money from our customer for the stock that we've sold in day 110. So it takes an average of 110 days to receive payment from customers. So our average receivable days is 45 days. To calculate our cash conversion, we simply add our average stock holding and receivable days together and take away the average payable days. So that makes it 75 days. Do you know what your cash conversion cycle is? You may be surprised. It's a calculation we can help you work out. And it's something that you can, something you can measure is something you can change. If you don't know what it is, then you can't change it. Ultimately, cash is king. If you want your cash conversion cycle to be as short as possible, the more cash you have in your business, the stronger it's going to be to weather the downturns more easily. Technically, if you increase cash by collecting debtors, your net assets don't improve because debtors go down and cash goes up. However, the higher your debtors are, the more risk there is of non-payment. And the quicker you convert your debtors and inventory into cash, the stronger your business will be and feel. You can negotiate good terms with your suppliers, then you can preserve your cash flow for longer. However, care is needed. You can't just not pay your suppliers, not pay your tax. It's not going to work long term. So make sure you're keeping a close eye on how long it's taking for your debtors to pay you. There's so many things you can do to get paid faster, like updating your terms of trade so clients expect to get demands for payment earlier, automating invoicing, simply chasing up your slow debtors with a process, and with perhaps an outsourcing process if you don't like doing that sort of work. Now let's put some of these strategies into play with our example, and it is going to get technical again, but stay with me and I can explain it later if you are struggling somewhere. That's going back to our business building example. We can see from the formula stock over cost of sales times 365 that stock turn has actually got worse. We are now taking 38 days to sell stock instead of 15. So although we've got more stock on hand, it's taking a lot longer to sell it all. So if we can really focus on strategies to reduce our stock and sell more off, and reduce it by 9 days, we'll find $13,000 extra in the bank account. That would be good. Let's look at work in progress. So work in progress is actually already improved. It's only taking 10 days to invoice, which is much faster than last year. Perhaps though, we could think about getting more prepayments before we start work, and progress payments, or faster processing of the invoicing. I know a client of mine that is really aiming to do it within 2 days. So he's got a 48-hour turnaround time. That's what he's predicting for himself, or set for himself, to reduce the invoicing time of his work in progress and keep his work in progress low. Another way is to actually have less jobs on, so you've got less distractions and you can just focus on getting through work in progress. So we do some more strategies. There's lots of strategies, but I've just named a few, and we can try and aim to reduce by 5 or 25 last year would have made a big difference. This frees up a big amount of cash of $7,500. So these little things all add up, of course, with this little bit of work. So the next focus on we're going to do is debtors. So debtors have been pretty consistent and we've actually improved them. But if we can reduce them further from 48 days down to 30 days, that would free up $31,000 worth of cash this year. It would have freed up $40,000 last year because the debtors were higher last year. So it's a really worthwhile thing to do to free up the debtors, reducing the debtor days. That's an easy strategy that I can see would be to make some calls and to put in some better terms of trade and just have less debtors going on. So in total, by doing those three strategies, we've increased the cash by $52,000. If we'd done it last year, it would have increased the cash by $91,000. So business has improved, but just hasn't improved enough. However, as I said to you before, it's taken 74 days now to pay suppliers. So they are really funding the business now. And if we try and reduce that 74 days down to 30, we'd have to pay back suppliers of $45,000. And that's definitely what I'd be recommending that this business owner do. So he gets that cash in, he pays down suppliers, and he just has a net cash improvement of about $7,000, but he has a lot less stress, or her has a lot less stress on the owner by waiting not so long to be paid and being able to pay suppliers on time. So to recap, our first strategy was to build profitability. Second was improving cash flow. The third area of focus to boost your balance sheet is to maintain solvency. As mentioned previously, there's two components of solvency, often referred to as the first and second limb. Firstly, the ability to pay your debts as they fall due is measured by ensuring that current assets are greater than current liabilities. The second asset is ensuring that total assets are greater than total liabilities, not just current ones. So let's look at what I mean by looking at the example again, because this is real stuff that I'm talking about, and it's every day, and it's really good that you know it. So here we've taken the total current assets of that same example that we had before, accounts receivable, shareholders, all those things that were in the balance sheet, we put them together and this is $227,000 worth of assets. We're focusing on this year. And we're putting in all the current liabilities. And you can see, well, the assets are over the current liabilities by the ratio of 1.31. So you go 227,721 divided by 174,468, you'll get to 1.31. That means that there's $1.31 of current assets for every dollar of current liabilities. Last year, the ratio was 1.55. The problem with this ratio is, as you know, there's a big thing called shareholders advance account, which isn't really a current asset because the shareholders are not likely to have that $66,000 sitting in a bank account to pay back to the company that they've taken out and spent on McDonald's and KFC and just the hundreds of other things that I see in flash restaurants. So this company, once we take that 66,000 out of the equation, 161 divided by 174 comes down to 0.92. So now we can see there's actually only 92 cents of current assets for every dollar of current liabilities. So the company is actually technically insolvent. Now legally, a director has a responsibility to keep the company solvent at all times. And so to fix this in the long term, and I have seen companies turn around many, many times, you have to go back to the first strategy that I mentioned at first and increase profitability. What is this company going to do that's going to increase the profitability of it and not make this $74,000 loss? In the short term though, this company needs an injection of cash from the shareholders or from a bank or from something to perhaps that bank overdraft converted to a bank loan to actually help manage it and manage being sustaining. So let's talk about the second part of the solvency test, total assets greater than total liabilities. Our net assets or total assets appear to be positive at 2,087. However, if we exclude the overdrawn shareholders' current account, the company is actually insolvent by that I've just gone too fast, by that $64,000 amount. Let's say 70 grand. So that's what we need to do. So if we put $70,000 and we adjusted the business by putting that $70,000 in, then there would be a solvent business. It still needs to increase profitability and cash flow, but at least the business is now solvent. So this brings us to the fourth and last stage of the boosting the balance sheet, and we can get on to questions very soon. So I've already covered the risks associated with the overdrawn shareholder advance account. The risk is that your company may get into personal difficulty and a liquidator can be called in and your personal assets are at risk. But a great way to avoid the overdrawn shareholder account problem is to regularly redo a personal budget so you can reduce the amount of drawings you take from the company, or and still cover all your expenses at home. So personal budgeting is always a rewarding and empowering thing to do, and I recommend you do it annually, especially right now when the economic situation is so uncertain. And while we're on the topic of personal budgeting, I recommend that you set a regular weekly amount that you take from the business and you stick to it. And I recommend many of my clients get set up in Smart Payroll or use a payroll service provider to pay tax, income tax on the wages as they take it out. But lastly, to protect you in the event the business does get into financial strife, having security for advances you've made to the company ensures that in a liquidation you stand a higher chance of getting your money back. So to recap, I've covered a huge amount of detail, and some of it is quite technical, and I appreciate that. It is difficult to get away from that because it is a balance sheet. The main message today is that balance sheet is fundamental to assessing your business strength and the value of your business. There are many things you can do to boost your balance sheet, including strategies to build profitability and grow your business, improve your cash flow, watch that you're maintaining solvency, and be particularly careful of the shareholder advance account going into debit. So my aim is to help you take what you've learned from this webinar and implement some positive changes into your business. So what are the next steps from here? Remember, doing nothing is not an option. Doing what you've always done, you're not likely going to change the results that you've always had in the past. So we need to plan for sustainable improvement. It starts with you as a leader of your business, and I suggest you make a plan. I have a lot of planning in my own business, and I'm doing it every day, every week, and every quarter, and every year. So, but because you cannot do everything at once, you have to focus on one clear strategies, maximum 3 or 4, and look at those things and work on those areas at once. You focus on what you can do rather than worry about what's out of your control, like the economy. So we are here to help you and do what we can to help you grow your business. These are some of the ways that we can help you, that if you'd like to, you can talk to us about. First of all, we prepare a cash flow forecast to help you plan for your cash inflows and outflows. It helps you implement strategies to improve your cash flow. So it's a full coaching service, and this involves about 6 meetings a year. The initial 2 for working out what the budget should be for the next year, and then a meeting every quarter to review the actual compared with your budget, and if necessary, rework the budget based on the new information. We'll give you an accurate quote based on the size of your business. And some of our clients using the service have been granted funding from the Regional Business Partner Fund to fund up to 50% of this cost. So contact us if you're interested in finding out more, and that would reduce the cost to you of to $1,500, and that's payable over the year. If you'd like to help in understanding your own numbers more, we do offer financial awareness coaching, and we are running quarterly group coaching at $195 per month. Our next class is in May. So if you'd like the invitation to come to these and understand your own balance sheet and profit and loss information a lot better, I really encourage you to come. If you're not ready to commit to a paid service and you're an existing client, we can send you out a complimentary balance sheet health sheet check for you to review your balance sheet. It's a really cool health check, and it's got all those ratios that I mentioned, debtor days and current ratios and all that, all worked out for you based on your numbers. So you don't have to do it yourselves, you don't do the sums. So if you go for that health check, I'd also recommend you worked with a complimentary review meeting. You book that in, and we looked at what your business health check says and what you want to do to improve those numbers. Feel free to sign up for our next webinar. We're going to be running one very soon with the questions that we're being asked about the new Brightline test and interest rolls, but there'll be other seminars that we are going to be doing monthly and webinars, so just watch those out in our newsletters that we send out to you. So I'm just wondering if anybody has got any questions that they would like to mention at this time.
There's a couple in the chat box here, Michelle. We've got, question and answer box. How do I do a personal budget?
Oh, that's a good question. Well, I'm suggesting the way that I do it is I look back 3 months of my personal bank statements and review all the spending, put it into a template, and then create an adjusted plan for the next 12 months. Later in this year, I will be running a webinar on this topic and sharing a resource on the personal budget. Some people don't like the term budget as it can focus on limiting your spending. However, I think about the budget about limiting a license to spend. So for example, if you have $1,000 budgeted for a holiday, you can book and plan a holiday knowing that when that holiday comes, that you're going to have those funds to spend them. But I do recommend that every home should have a budget.
Got another one here. Is the shareholder advance account, is that the renamed version of the drawings for the current year, and the shareholder loan account for the previous year?
Yes, the shareholder current account is usually the heading, and in the shareholder current account there would be an opening balance, there'll be a funds introduced during the year, there'll be drawings, there'll be tax paid personally, and then there's a loan, the balance at the end, which is often called the shareholder loan. So yeah, it is all about that area, definitely. There can be more details, and when we produce a zero report, there's usually a separate page just for the current shareholder current account, and it's got all the details in it, and then that balance is brought through to the balance sheet.
Okay, and one more question. If I want to increase my cash flow, what's the first step?
I think the first step is looking back to the past to look at what caused the present cash flow problem, because we don't want to create a forecast if there's a massive viable business potential problems, and so in that case we have to fix the profitability problems before we can fix the cash flow. But then yes, I would create a cash flow by looking back on the past and trying to work out what the future will be. Sometimes we do it to get funding, extra funding from a bank, and the government's funded a small business loan of 10 grand plus 1,800 per full-time employee. The boost cash flow spending for businesses, and some of our clients have taken advantage of this. And this is a loan, not a grant, so it does have to be paid back. So if the business idea is actually not viable for whatever reason, the debt would only prolong the inevitable and thus not recommended. So so that's what I would do.
Okay, we've got one more question. The cash conversion date formula, was that the stock holding days plus accounts receivable days minus accounts payable days.
Yes, very good. Well done. I can go back to that slide very quickly if I can. Actually, no, I can't. It's well back. But if you want to send, if you want to get notes on this webinar, then just email us at the end and we'll send out notes to you. So, is there any other questions, Rhonda?
No, none so far.
Okay, that's good. So, before we go, I would like to share this quote with you. Business is many things, the least of which is the balance sheet. It's a fluid, ever-changing, living thing, sometimes building to great peaks, sometimes falling to crumbled lumps, by Howard Green. I was in a seminar with other accountants a week ago, and we had the ANZ Bank presenting to us about how strong balance sheets mean that companies can borrow on equity in their business. And I've actually not seen this in practice, and so I had a good talk with the ANZ Bank and you know, when I spoke with them, and I unfortunately I do believe that while the information was correct for most small businesses, it is very difficult to get into a sound position on their balance sheet. It takes many years. So I encourage you to make a simple plan today, commit to at least one action that you're going to take as a result of today's webinar, write it down, give it to somebody else to keep you accountable for it, and make sure that there's a completion date. Remember to ask for our support. We're here for you if you need us, and we'd love to help. So thank you so much for attending and participating in this webinar and the questions. I will be giving you a feedback on exit from the webinar. There's a few simple questions. I'll actually just open that poll now. No, I haven't opened it yet, but I will open it at the end. And I hope I've given you some ideas to ponder and some clear next steps for you and your business. Thanks again for participating, people. I hope it's been helpful. Bye-bye.